Stop. Do not refresh your chart. Do not comfort yourself with "it'll bounce." Look at what is happening right now and understand the difference between a normal pullback and a programmed dump. Silver is not randomly crashing. It's not a mystery. It's not the market waking up and deciding it hates silver today. It's a schedule. A rules-based sell program tied to the annual Commodity Index rebalancing, a window that began on January 8th, 2026, and runs across the second week of January. Passive funds are forced to reduce silver exposure to match new index weights, and multiple reports estimate roughly $6 to $7 billion worth of silver futures could be sold during this window. This is not an opinion, this is the plumbing. And when you slam that much paper into a market in a short span of sessions, the chart doesn't discover price. It gets pinned to a conveyor belt. Today I'm going to give you the blueprint that most people never learn. What the 7 billion sell-off actually is. Why it hits like a truck, even if the long-term thesis is still intact. How the cascade works. Forced selling, liquidity gaps, stop hunts, margin pressure, panic. The exact checklist you use to avoid becoming the liquidity. Not financial advice. This is market mechanics and risk management, the stuff that actually keeps your money alive. If you're new here, I don't narrate candles like bedtime stories. I translate what the machine is doing, so you don't get trained by it. Because the market doesn't forgive. It trains you. It trains you to buy at the worst time, sell at the worst time, and then blame volatility. So, let's break the spell. The lie you're being fed, and the real reason the floor just dropped. Here's the lie. Silver is crashing because something terrible happened. That's what your brain wants, because your brain loves single causes. One villain, one headline, one explanation that lets you sleep. But the market almost never moves on one cause. It moves on order flow. And this week, order flow has a name. Index Rebalancing. Think of a commodity index like a recipe. Every year, the index provider updates the ingredients and the percentages. It's not a prediction about the future. It's a rules update based on liquidity and production metrics and diversification caps. Now, here's the part that matters. Trillions of dollars around the world are managed with rules. Pension funds, institutional allocations. Set it and forget it passive products. Their mandate is simple. Track the index. So when the index says your silver weight is lower now, those funds do not debate it. They do not wait for a better price. They do not care about your support line. They sell because the rule says sell. Multiple outlets have reported that passive index tracking funds are expected to sell around $6.8 billion of silver futures during the rebalancing, a figure described as roughly 12% of open interest on the COMEX. Other estimates put the silver sell program around $6 billion to $7 billion worth across the rebalancing sessions starting January 8th. So if you're watching the price and asking, why is silver crashing right now? Start here. Because a large, non-emotional seller showed up with a calendar and a mandate. No fear, no greed, no hesitation, just size. And size moves price. What does $7 billion of selling mean in silver terms? People hear $7 billion, and it sounds like a headline. Big number, shrug, scroll. But you need to feel what it means in ounces, contracts, and pressure. Let's do the math together, slowly. A standard COMEX silver futures contract controls 5,000 ounces of silver. That's the lever, that's the pipe. Now, if silver is trading around $75 per ounce, a notional $7 billion corresponds to 7 billion divided by 75 equals about 93 million ounces of silver. 93 million ounces. Divide that by 5,000 ounces per contract, and you get around 18,600 futures contracts. And remember, this is not one trade. This is a program executed across a handful of sessions, so the tape sees consistent selling pressure day after day during the rebalance window. That's why your technical levels feel like paper walls, because they are being hit by a battering ram that doesn't stop to admire the architecture. Why this hits silver harder than most people expect. Silver is not like a slow, deep market where you can quietly unload size without impact. Silver is a high beta metal. It moves fast. It's liquid until it isn't. And when a forced seller meets thinner liquidity, you get air pockets. This is why you can see violent swings, intraday ranges that look insane to anyone who thinks commodities behave politely. One report noted silver swinging violently between roughly $73 and $80 during the initial days of the rebalancing pressure. And in India, the MCX March silver contract was reported down sharply as well, alongside global weakness. So the move feels like crashing. But mechanically, what you're watching is forced flow colliding with a market that can gap. The 5-layer cascade that turns forced selling into panic. Here is what most people miss. The index rebalancing is the match, but the fire spreads because of the structure around it. Layer 1, passive index selling. This is the seed. The initial pressure. Layer 2, dealers hedge and widen. Market makers see the flow and protect themselves. Spreads widen. Liquidity thins. Small orders move price more than usual. Layer 3, stops get triggered. Retail stops, systematic stops, swing trader stops, support breaks, and the break becomes its own selling. Layer 4, trend followers and CTAs flip. Trend systems don't care about your story. They care about signals. Like when the short-term trend breaks, they add fuel. Layer 5, margin pressure and liquidation. Leveraged longs who bought the top, the it looked unstoppable crowd, start getting margin calls. They sell not because they changed their mind, but because they ran out of room. And that final layer is what turns a normal pullback into a flush. So when you feel the chart accelerating downward, it's not one thing. It's a chain reaction. And yes, I use the word chain on purpose, because that's what this is, a chain of rules, hedges, stops, and forced decisions. Why the fundamental thesis can be right and your entry can still be wrong. This is the brutal truth. You can be right long-term and still get wrecked short-term, because markets are not morality plays. Price does not reward correct beliefs on your timeline. Price rewards positioning, liquidity, and survival. And this is why the market is such a punishing teacher. It will let you be right after it teaches you a lesson. So if you're sitting there thinking, wait, silver shortages, industrial demand, monetary fear, none of that changed overnight. You're correct, and that's exactly why this crash is so effective psychologically. It makes people doubt the thesis, not because the thesis died, but because the tape is violent. This is how metal transfers from weak hands to strong hands, not through logic, through stress. The blueprint. How you stop getting harvested, I'm going to give you a checklist, not a prediction, not a hype speech, a checklist. Because in a programmed sell window, the only edge you have is structure. Here it is. Rule 1, know the calendar before you touch the button. If major index rebalancing runs January 8th through the second week of January, you treat that window like a storm. You do not pretend it is a sunny day. Rule 2, separate paper flow from physical reality. Rebalancing operates in futures, paper exposure. Physical supply does not magically appear because a fund sold a contract. Saxo Bank has explicitly noted that these index adjustments operate entirely in the paper futures market, while physical fundamentals can remain tight. Rule 3. Decide your lane, trader, investor, or stacker. A trader needs stops, targets, and timeframes. An investor needs sizing and patience. A stacker needs discipline and spread awareness. Most people mash these together and die. Rule 4. Stop buying proof. A vertical candle is not proof. A breakout print is not proof. It is a test. The market prints levels to see who will chase. Rule 5. Use scale, not ego. In volatility windows, one-shot entries are ego plays. Scaling is a survival play. Rule 6. Measure your stress, not your conviction. If the move makes you unable to sleep, your position size is wrong. That is not philosophy. That is risk management. We're going to take each rule and turn it into a simple action plan. What exactly is this index rebalancing thing? Let me make it brutally simple. Imagine a giant cargo ship. On that ship are containers labeled gold, silver, oil, copper, wheat, natural gas, and dozens more. That ship is the commodity index. At the start of each year, the ship's captain checks the rule book and says, some containers got too heavy, some got too light, we have to rebalance so the ship doesn't tip. So he orders cranes to move containers. Now here's the key. Those cranes do not care if the ocean is rough. Those cranes do not care if the price is unfair. Those cranes do not care if you think silver should be higher. They move the containers because the ship must stay balanced. In the real world, the cranes are passive funds. The rulebook is the index methodology, and the moving happens through futures. Business Standard reported that this rebalancing is managed by Bloomberg and S&P global indexes, and that passive funds will likely sell outperforming assets and buy underperformers to match the new weights. They also reported something that matters a lot. Silver's weight in the Bloomberg Commodity Index was reduced from about 8.19% in 2025 to about 3.94% in 2026, and the S&P GSCI weight for silver was also reduced from about 1.23% to about 0.65%. Translation: the index is saying, you own too much silver compared to the new recipe. So the index trackers must cut. That is why you're seeing pressure, even though the narrative hasn't suddenly collapsed. But why now? Why this week? Because the rebalancing window happens on a schedule. Multiple sources describe the adjustment occurring in the second week of January, beginning January 8th and running across several sessions. Economic Times described passive tracking funds selling precious metals futures from Thursday to match the new weightings, noting that the process is usually routine but is significant this year because of the prior rally. So yes, this is a calendar event. And here's the uncomfortable truth. If you didn't know the calendar, you were trading blind. The second engine. Macro data makes the sell-off feel worse. Index flow is the big hammer, but macro conditions can make the floor slippery. Business Standard noted that U.S. services data, ISM, came in stronger than forecast, and it also ran through ADP and JOLTS data, information that can push the U.S. dollar and bond yields around. Why do you care? Because silver is priced in dollars. When the dollar strengthens and yields rise, metals often face headwinds in the short term. Not because the metal became less useful, because the financial system reprices risk. So you've got a forced seller dumping futures and a macro backdrop that can amplify risk-off behavior. That combination is how you get crashing right now. The most important sentence in this video, ready? A programmed seller doesn't stop at your comfort level. They stop when the mandate is complete. That's it. So your job is not to guess the bottom. Your job is to stop donating to the machine. The rebalance window map, the only thing you need to see clearly. I want you to picture the next few sessions like this. Phase A, the announcement and positioning before the window, smart money positions. Volatility creeps in. Everyone pretends it's normal. Phase B, the forced flow begins. The first day or two are messy. Price swings hard. People argue about manipulation and bad news, but it's mainly flow. Phase C, the liquidity trap. As the market realizes the selling is persistent, bids step back. You get air pockets. Support levels become speed bumps. Phase D, the flush. If enough leverage is in the system, you get a sudden drop. A day where it feels like gravity doubled. Phase E, the absorption. Eventually, price finds a zone where buyers start absorbing the flow. Not because support is magic, because the seller is meeting real demand. Phase F, the post-flow repricing. When the mandate ends, the market reassesses. Sometimes you get a dead cat bounce, sometimes you get a powerful reversal, sometimes you get a grind. The point is, during the window, you respect the flow. After the window, you look for the new regime. Why technical analysis fails during forced flow and how to use it properly. I'm not anti-chart, I'm anti-delusion. Charts are a map of past trades. In a normal market, levels matter because traders react to them. But in a forced flow market, the seller can overwhelm reaction. That's why you can watch. A perfect support line break like it wasn't there. A clean moving average get cut like paper. A Fibonacci level get shattered and then reclaimed an hour later. So how do you use technicals in this environment? You use them as zones, not as commandments. You think in probabilities, and you size accordingly. Here's the upgrade. Instead of saying, this level will hold, you say, if the market is going to stabilize, it will probably happen in this zone. And I will only engage with a plan that survives if it doesn't. That one shift will save you a fortune. The emotional trap. The machine sets for you now. I'm going to describe something, and you're going to recognize yourself or someone you know. Step 1, silver runs. It prints a big number. People screenshot it. They feel smart. Step 2, the dip begins. People say, healthy pullback. They buy the first dip. They feel even smarter. Step 3, the dip becomes a drop. Their account goes red. They look for confirmation. They find a tweet. They find a chart. They find someone yelling, to the moon. They hold. Step 4, the drop becomes a flush. They panic. They sell. They swear off silver forever. Step 5, price stabilizes and rebounds, and the metal ends up in stronger hands. That is the training program. And the index rebalancing window is a perfect lab for that training program. The paper versus physical divide and why it matters more than ever. Saxo Bank put it plainly. These index adjustments operate entirely in the paper futures market. Physical markets are not directly affected by those flows. Here's the translation for your brain. A futures contract is a financial instrument. It is exposure, it is leverage. It can be sold in seconds. A physical bar is an object. It exists in space. It has to be moved, insured, stored. The two markets touch, but they do not move at the same speed. During forced selling windows, paper can crash fast. Physical premiums can behave differently, and the emotional mistake is thinking paper weakness automatically means the thesis is dead. No. Sometimes it means paper is being dumped because rules demand it. This is why experienced players separate price action from structural reality. What the sell-off is not. Let's kill the myths quickly. Myth 1. Somebody knows bad news. Not necessarily. Forced flow can create the move without a headline. Myth 2. Silver demand disappeared overnight. Industrial demand doesn't vanish because a futures program runs. Myth 3. This proves silver was a bubble. A pullback does not disprove a structural story. Myth 4. If it's manipulation, I should buy more right now. No. If it's forced flow, your job is to respect it, not to fight it. The correct posture is not rebellion, it's strategy. And that brings us to the practical playbook. Why this year's rebalancing is so violent. 2025 was not normal. To understand the violence, you need to respect what happened before it. Silver did not drift up gently last year. It ripped. Reuters reported that silver rose over 147% in 2025, driven by factors like supply tightness, low inventories, and strong industrial and investment demand. Economic Times described silver having surged over 150% in 2025 and being viewed as more vulnerable in the near term because of sharp price moves and investor enthusiasm. When an asset has that kind of year, it grows in index weight. It becomes a bigger container on the ship. And then the diversification rules kick in. And then the index says, reduce. So the bigger the prior rally, the bigger the forced adjustment. That is why this rebalancing isn't a sleepy little accounting exercise. It's a real flow event. The $7 billion is not every seller, it's the baseline. This is critical. The rebalancing estimate is the baseline forced flow. On top of that, you have traders front-running it, traders reacting to it, leveraged players getting squeezed, and systematic systems flipping. So if you think $7 billion is the total, you're missing the compounding effect. Forced flow is like a boulder rolling downhill. It knocks loose more rocks, and soon the rocks become a landslide. If you feel sick watching this, it's because you're fighting reality. I need you to hear me. Feeling uncomfortable does not mean something is wrong. It means you are seeing a part of markets that most people ignore. Most retail investors live in a fantasy. They think price moves because markets are deciding value, but real markets move because of flows, mandates, and positioning. So your discomfort is the sound of your old story breaking. Good. That's how you upgrade. The strong hands are not smarter. They're structured. Let's talk about strong hands. Strong hands are not magically smarter humans. Strong hands are players whose structure allows them to survive volatility. They have better sizing, better funding, better patience, and better information about flow windows. Weak hands are not stupid. Weak hands are people whose structure forces them to sell at the worst moment. They used too much leverage. They bought too late. They had no plan. They were trading emotion. So when you ask, who wins in a crash like this? The answer is, whoever is not forced to make decisions under stress. The triage plan. If you bought near the top. I'm going to speak to you directly because I know a lot of you did. You saw silver at a big number. You felt the urgency. You didn't want to miss it. You clicked buy. Now you're watching the chart and your mind is doing three things at once: shame, panic, and bargaining. Here is the triage plan. Slow, clean, mechanical. Step 1, stop adding in panic. Do not average down because you want relief. Only add if you have a structured plan and enough liquidity to survive more downside. Step 2, separate your position into buckets. Bucket A, long-term conviction capital, money you can hold. Bucket B, trading capital, money that needs a stop. Bucket C, ego capital, money you bought to feel right. If you cannot define the buckets, you are not managing risk. You're gambling. Step 3, calculate what a further drop would do to you emotionally and financially. If another 10% down would break you, you are oversized. Oversized positions don't build conviction. They create forced selling. Step 4, decide your rule for being wrong, not your hope. Your rule. Rule examples. If it breaks this zone and closes below it for 2 sessions, I reduce. If volatility remains elevated through the rebalance window, I hold off on adding. If I'm in leverage, I cut leverage first. Step 5. Restore oxygen. Your first job is not to make it back. Your first job is to survive. Survival is the superpower. The market will give you opportunities if you stay alive. The playbook. If you have no position and you're watching the blood. If you are flat, no position, you are in a position. You have the best asset in the world right now. Clarity. Here's the playbook. Let the forced seller do their work. Watch for evidence of absorption. Engage only when you can define risk. So what does absorption look like? Absorption is not a green candle. Absorption is behavior. The market sells hard and cannot make new lows. Volume increases, but the range starts to compress. Dips are bought faster. The tape starts to feel heavier on the downside and lighter on the upside. This is how you read the moment the machine loses control. It stops being able to push price easily. The absorption checklist. Print this in your brain. When you think the dump is ending, ask A. Are we still inside the rebalancing window? If yes, assume more flow can hit. B. Did we get a capitulation candle, a wide-range bar that frightens everyone? C. Did the next session fail to extend lower? If it doesn't extend, it's a signal. D. Are we seeing repeated rejection of lows, multiple probes down that get bought? E. Is volatility starting to contract? Not low, just contracting. F. Are correlated markets confirming? If gold, copper, and the dollar are all doing something, it matters. Not always, but often. If you can't answer these, you're guessing, and guessing is expensive. The three doors. How this can play out without predicting. I'm not going to tell you tomorrow will be green. Anyone who promises that is selling dopamine. But I will give you the three main paths and how you behave in each. Door 1. The bounce and chop price bounces hard, then chops sideways while the seller finishes. This feels like relief, but it can be a trap because the flow can reassert. Your behavior. Don't chase the bounce. Let the range form. Buy edges, not the middle, if you're a trader. If you're an investor, scale only with patience. Door 2. The grind lower price bleeds lower in a controlled way as bids step back. No dramatic flush, just steady erosion. Your behavior. Treat it like a storm. Keep size small, avoid leverage, wait for a clear base. Door 3. The flush and reversal. The market dumps hard, causes mass panic, then reverses sharply when absorption arrives. Your behavior. Don't try to catch the falling knife. Wait for the knife to hit the table, then pick it up by the handle. Look for a reversal structure. A low, a retest, then a higher low. These are not predictions. They're response plans. Why catching the bottom is a sucker's game. Let me tell you what catching the bottom really is. It's a desire to prove you're special. But markets don't pay you for being special. They pay you for being disciplined. If you want to win long term, you stop trying to be the hero. You try to be the survivor. The leverage illusion, the part that makes silver a killer. Silver futures and leveraged products amplify everything. When you control 5,000 ounces with a contract, small percentage moves become large profit and large loss. That's the attraction. That's also the trap, because leverage makes you fragile, and fragility is what the machine feeds on. So if you want to stay in this game, your number one priority is reducing fragility during forced flow windows. The why now question, revisited. This is also about human psychology. Why does the machine love doing this after a big rally? Because a big rally creates late buyers, high leverage, and emotional attachment. Those are the three ingredients of a beautiful flush. The market doesn't punish you for being bullish. It punishes you for being late and leveraged. The bottom line, mechanism in one sentence. The 7 billion sell-off is forced, rules-based futures selling during a narrow window, and it creates a cascade of second-order selling that looks like crashing, even if the longer-term story hasn't disappeared. Now let's go deeper, because I promised you value, not headlines. The plumbing tour, where the selling actually happens. Let's go under the hood. Silver is traded in many venues: spot, ETFs, physical bars, coins, OTC forwards. But the fastest pressure valve is the futures market, because futures is where big exposure can be added or removed instantly. And that is exactly where passive rebalancing is executed. When Economic Times says passive tracking funds are selling precious metals futures, that's not a poetic phrase. It's literal. The trades happen in futures. So what does that mean for the chart you watch? It means the price you see is heavily influenced by financial positioning. And when financial positioning is forced, the price can temporarily detach from what you feel is fair. Why silver gets hit harder than gold in these windows? Gold is bigger, deeper, and more widely held. Silver is smaller and more volatile, and several reports note that silver can be more exposed to rebalancing-related selling pressure. Business Standard emphasized near-term risk from the 5-day rebalancing pressing precious metals and highlighted that roughly $6 billion of silver futures were set to be sold. Economic Times cited Citigroup estimates around $6.8 billion in silver futures potentially being sold, and described silver as vulnerable due to sharp price movement. The Financial Times summary also relayed a JP Morgan estimate of roughly $6.1 billion in silver selling, equal to about 10% of COMEX open derivatives contracts. When you're talking about 10% of open interest in a short window, that's not noise. That's a storm. Is this manipulation? Here's the adult answer. People love the word manipulation because it offers a villain. And yes, markets can be gamed. But today, the most powerful force is simpler: rules. A big seller is selling because the rules demand it. Now, can other players exploit the window? Of course. If you know a mandated seller is coming, you can. Step back bids to let price drop faster, front run with short positions, trigger stops, then cover into the panic. That's not a conspiracy theory. That's how predators behave in any market. But you don't need to argue about morality. You need to understand the terrain. The predator's timeline, so you stop playing victim. If I'm a professional trader and I know there's a forced seller, step 1, I position ahead of the window. I short rallies, I sell calls, I get paid for volatility. Step 2, I push when liquidity is thin. I look for moments where price can gap. Step 3, I hunt stops. I push just below obvious levels. Step 4, I cover into the flush. I buy back when everyone is emotional. Step 5, I watch for reversal, because forced selling ends, and when it ends, price can snap back violently. That is the predator's timeline. Your defense is, don't place your money where predators already know it will be eaten. The retail timeline, the one that gets you broke. The retail timeline is the opposite. Step 1, buy after the rally. Step 2, hold through the first dip. Step 3, add because it's on sale. Step 4, panic sell at the flush. Step 5, watch it bounce without you. You are not losing because you are unlucky. You are losing because you're following a script that was written to feed the machine. We're rewriting your script right now. The 4 filters that protect you in every forced flow event. You want a simple framework you can reuse? Here it is. Filter 1, calendar. Filter. Are we in a known flow window? Rebalance, roll, tax loss, option expiry? If yes, reduce aggression. Filter 2, volatility filter. Is volatility elevated relative to normal? If yes, reduce leverage and widen expectations. Filter 3, flow filter. Is there a known non-emotional buyer or seller? If yes, respect it. Filter 4, psychology filter. Do you feel urgency? If yes, pause. Urgency is usually the trap. When all 4 filters flash danger, you do not full send. You either wait or you engage with tiny size and clear risk. The $7 billion does not mean $7 billion of physical bars. This is a critical misunderstanding. When we say $7 billion of selling, we're usually talking about notional value in futures contracts. Those are paper exposures. A futures contract can be closed with an offsetting trade. It does not necessarily mean someone delivered a bar, so don't let anyone confuse you with fake certainty like $7 billion means vaults emptied. No, it means exposure was sold in the fastest market. But here's where it gets interesting. Even paper selling can influence physical because it sets the reference price. And the reference price influences premiums, spreads, and sentiment, so paper can slam the screen price. Physical can respond differently. This is why you must hold 2 thoughts at once. Paper can move fast and violently. Physical reality can remain tight underneath. The metal transfer event. How weak hands lose metal without realizing it. Let me show you how the transfer happens in a way you will never forget. Picture a crowded room. Everyone is holding a ticket. That ticket is their position. Now the lights flicker, music stops, a siren goes off. The exits are narrow. Most people panic. They throw their ticket away to reach the exit faster. A few people stay calm. They collect the tickets off the floor. When the lights come back on, the calm people own more tickets. That's the transfer. The market doesn't steal from you. It pressures you into giving up your position at the worst moment. The price is crashing. Headline is meant to do one thing: speed up your decision. Here's a psychological trick. The more scared you are, the faster you decide. The faster you decide, the worse your decision quality. The worse your decision, the more likely you donate to the machine. So when you see silver is crashing right now, your job is to slow down. Slow is professional. Fast is emotional. The real question: who is in control right now? During the rebalance window, control belongs to the forced flow. Not forever, not for the rest of the year. But in this window, control belongs to the seller. So the correct question is not, is silver bullish long term? The correct question is this the week to press my luck or the week to respect flow? The evidence you should be looking at instead of Twitter. I'm going to give you a short list of evidence types that matter more than opinions. Rebalance dates and estimated notional flows. Futures open interest trends. Are positions being liquidated or transferred? Volatility and intraday range behavior, whether new lows are accepted or rejected. ETF flows and positioning as a secondary, not primary indicator. On ETF flows, one report noted a large single-day outflow from silver-backed ETFs coinciding with heightened volatility during the rebalancing period. Treat that as supportive context, not as the sole driver. The driver is still the forced futures flow. Let's talk about support at 70 without lying to you. You will hear people say, 70 is support. Buy the dip. Maybe. But here's the honest version. Support is not a number. Support is the point where demand overcomes supply. During forced flow, supply is not normal, so support levels need confirmation. Business Standard mentioned the idea that if silver holds the support of $70, investors may consider buying the dip. But notice the wording, if it holds. That if is everything. Professionals don't marry a level. They test it. The test protocol, how you let the market prove itself. If you want to engage, here's a clean protocol. Step 1, identify your zone, not one line, a zone. Step 2, wait for the first test. Price hits the zone, bounces. Step 3, wait for the second test. Price comes back. Does it make a lower low or a higher low? Step 4, only scale after the market shows higher lows or clear absorption. No absorption, no scale. This prevents you from catching knives. It keeps you from being the first buyer in a forced selling avalanche. Why rebounds can be violent after these events. Here's a strange truth. The same flow that creates the crash can create the rebound. Why? Because when sellers finish, the market is under-owned. Shorts get crowded, liquidity returns, and price can snap back. That's why you can see V-shaped moves in silver. Not because the market is crazy, because positioning resets. So again, your edge is not predicting. Your edge is being prepared to act when the regime shifts. The mid-video wake-up call. If you're still watching right now, do one thing. Hit subscribe. Not because I need it, but because you need a signal in the noise. This channel is not hype. It's survival training for a market that punishes laziness. Now, let's finish the blueprint. The what to do next checklist for 3 types of viewers. Viewer type A, you own silver, no leverage, long-term horizon. Your job, do not panic, do not overtrade, review your position size, use the window to learn, consider scaling only if you can handle volatility. Viewer type B, you own silver, you used leverage, short-term horizon. Your job, reduce fragility immediately, cut leverage, tighten your plan, accept that survival is more important than pride. Viewer type C, you don't own silver yet. Your job, watch the forced flow, wait for absorption, enter with a structured scale plan, not with adrenaline. The no-shame rule, the rule that keeps you in the game. The market is designed to make you ashamed. Ashamed people trade emotionally. Emotional trading feeds the machine. So here's the rule. No shame, only data, only structure. You learn, you adapt, you survive. The story you should tell yourself today. Not, I'm a genius and the market is wrong. Not, the market is rigged and I'm powerless. The correct story is, there is a forced flow event in progress and I will not donate liquidity to it. That's it. The fast summary, so you can explain this to someone else. Tell them this. Silver is crashing because passive index funds are rebalancing and are forced to sell several $1 billion worth of silver futures during a short January window, and that forced flow triggers a cascade of stop-loss selling and leverage liquidation that amplifies the move. If they understand that one sentence, they stop being confused. Deeper, why index flows are blind and why that matters. Index flows are blind. They don't have opinions. They don't have patience. They are not smart. They are rules. And rules can create distortions. That's why sometimes you see a commodity dumped even while fundamentals are tight, or a commodity bought even while sentiment is bad, because the index is a recipe, not a brain. This is why you never confuse a flow event with a fundamental verdict. The final warning, do not let a single week define your whole thesis. People make a deadly mistake. They let one violent week define their beliefs. This is how markets erase years of conviction in days. You don't do that. You zoom out. You separate flow from thesis. You manage risk. You stay alive. Endgame, what I'm watching as this window plays out. Here are the only things I care about in the next sessions. Does selling remain persistent at the same times each day? That's a clue the program is executing. Do lows keep getting accepted? If yes, don't step in heavy. Do we see a day where the market tries to break lower and fails? That's the first real signal of absorption. Do we see a retest that holds higher? That's the second signal. Does the market rally even while the window is still active? If yes, that is strength beyond forced flow. Remember, last year's rebalancing also created notable price dynamics, and similar events can be absorbed if real demand shows up. If you take nothing else from this video, take this. Silver didn't randomly crash. A machine is executing a schedule. Your job is not to fight the machine with emotion. Your job is to see the machine. Step aside while it swings and then step in only when it loses momentum. That's how you stop being harvested. If you want my next breakdown, the one where I map the exact post-rebalance reversal signals and the traps that come after the first bounce, subscribe and turn on notifications, because the next move is where most people get tricked twice, and you're not doing that this year.